Investing can intimidate a lot of people because there are many options, and it can be hard to figure out which investments are right for your portfolio. This guide walks you through 10 of the most common types of investments, from stocks to crypto, and explains why you may want to consider including each in your portfolio. So before we get started, make sure to hit that like button. Subscribe to our YouTube channel for our future updates. Number 10. Commodities. Commodities are physical products that you can invest in. They are common in futures markets where producers and commercial buyers, in other words, professionals, seek to hedge their financial stake in the commodities. Retail investors should make sure they thoroughly understand futures before investing in them. Partly, that's because commodities investing runs the risk that the price of a commodity will move sharply and abruptly in either direction due to sudden events. For instance, political actions can greatly change the value of something like oil, while weather can impact the value of agricultural products. Number 9. Cryptocurrencies. Cryptocurrencies are a fairly new investment option. Bitcoin is the most famous cryptocurrency, but there are countless others, such as Litecoin and Ethereum. These are digital currencies that don't have any government backing. You can buy and sell them on cryptocurrency exchanges. Some retailers will even let you make purchases with them. Cryptos often have wild fluctuations, making them a very risky investment. However, some investors use them as alternative investments to diversify their portfolios beyond stocks and bonds. Number 8. Annuities. Many people use annuities as part of their retirement savings plan. When you buy an annuity, you purchase an insurance policy, and in return, you get periodic payments. Annuities come in numerous varieties. They may last until death or only for a predetermined period of time. They may require periodic premium payments or just one upfront payment. They may link partially to the stock market, or they may simply be an insurance policy with no direct link to the markets. Payments may be immediate or deferred to a specified date. They may be fixed or variable. Annuities can guarantee an additional stream of income for retirement. But while they are fairly low risk, they aren't high growth. So investors tend to make them a good supplement for their retirement savings, rather than an integral source of funding. Number 7. Options. An option is a somewhat more complex way to buy a stock. When you buy an option, you're purchasing the ability to buy or sell an asset at a certain price at a given time. There are 2 types of options: call options for buying assets and put options for selling options. As an investor, you lock in the price of a stock with the hope that it will go up in value. However, the risk of an option is that the stock could also lose money. So if the stock decreases from its initial price, you lose the money of the contract. Options are an advanced investing technique, and retail should exercise caution before using them. Number 6. Retirement plans. There are a number of types of retirement plans. Workplace retirement plans, sponsored by your employer, include 401 plans and 403 plans. If you don't have access to a retirement plan, you could get an individual retirement plan, IRA, of either the traditional or Roth variety. Retirement plans aren't a separate category of investment per se, but a vehicle to buy stocks, bonds, and funds in 2 tax-advantaged ways. The first lets you invest pre-tax dollars, as with a traditional IRA. The second allows you to withdraw money without paying taxes on that money. The risks for the investments are the same as if you were buying the investments outside of a retirement plan. Number 5. Certificates of deposit CDs. A certificate of deposit CD is a very low-risk investment. You give a bank a certain amount of money for a predetermined amount of time. When that time period is over, you get your principal back, plus a predetermined amount of interest. The longer the loan period, the higher your interest rate. Number 4. Exchange-traded funds, ETFs. Exchange-traded funds, ETFs, are similar to mutual funds in that they are a collection of investments that tracks a market index. Unlike mutual funds, which are purchased through a fund company, shares of ETFs are bought and sold on the stock markets. Their price fluctuates throughout the trading day, whereas mutual funds value is simply the net asset value of your investments, which is calculated at the end of each trading session. Number 3. Mutual funds. A mutual fund is a pool of many investors' money that is invested broadly in a number of companies. Mutual funds can be actively managed or passively managed. An actively managed fund has a fund manager who picks securities in which to put investors' money. Fund managers often try to beat a designated market index by choosing investments that will outperform such an index. A passively managed fund, also known as an index fund, simply tracks a major stock market index like the Dow Jones Industrial Average or the S&P 500. Mutual funds can invest in a broad array of securities, equities, bonds, commodities, currencies, and derivatives. Mutual funds carry many of the same risks as stocks and bonds, depending on what they are invested in. The risk is often lesser, though, because the investments are inherently diversified. Number 2. Bonds. When you buy a bond, you're essentially lending money to an entity. Generally, this is a business or a government entity. Companies issue corporate bonds, whereas local governments issue municipal bonds. The U.S. Treasury issues treasury bonds, notes and bills, all of which are debt instruments that investors buy. The rate of return for bonds is typically much lower than it is for stocks, but bonds also tend to be a lower risk. There is still some risk involved, of course. The company you buy a bond from could fold, or the government could default. Number 1. Stocks. Stocks, also known as shares or equities, might be the most well-known and simple type of investment. When you buy stock, you're buying an ownership stake in a publicly traded company. That brings us to the end of this video. What do you think of our video? Let me know in the comment section below. If you enjoyed the video, make sure to hit that like button. Subscribe to our YouTube channel for our future updates. Thank you for watching.